Since Donald Trump announced tariffs on the rest of the world, the S&P 500 is down 10% and falling. Other global stock markets have fallen dramatically as well. So many European investors are asking, is it time to buy the dip? In other words, should you buy stocks now while they are cheaper? Somebody even asked me if they should take a loan and buy the S&P 500. Over my 17 years of investment experience, including the time I spent as the CEO of a European investment company which today manages over 1 billion euros, I have seen several market crises. Based on that experience, as well as hundreds of market studies, in this video I will show you the case for buying the dip, and then I will explain the associated risks. And finally, I will reveal what is, in my view, the best evidence-based strategy right now. So first, the case for buying the dip. There are three popular arguments you hear. First, you should buy stocks now because eventually the stock market always goes back up. Just look at this chart of the US stock market over the past century. There have been many dips along the way, but always, if you simply waited long enough, the market recovered in a powerful way. When you first hear this, the logic seems kind of weak. Just because the market always recovered before, does that mean it's going to do so again in the future? Some people feel like the stock market is a house of cards, and maybe this time it will finally collapse for good. But when you think about it deeper, the resilience of the stock market does make a lot of sense. A stock is not an abstract record in some electronic database. When you invest in the stock market, you're investing in hundreds of real companies all over the world. Millions of real people work at these companies every day to serve their clients and make money. Now, when there's a big disruption in the global economy, like America raising tariffs, obviously that can cause a lot of trouble for these companies. Costs go up, profits go down, and some businesses may even go bankrupt. But over time, the effort and creativity of these millions of people, it all really adds up. And that's why the stock market has been unstoppable despite 2 world wars, pandemics, and various market crashes. And from this perspective, it can absolutely make sense to buy any dip. Now, there are some dangers with this. But before I get to that, here's the second argument for buying the dip. You are buying stocks at better valuations. In other words, cheaper. Think about it like this. When you see some delicious strawberries at the farmer's market, priced at 5 euros per kilo, you're happy to buy 1 box. But if today there's a discount down to 4 euros, maybe you'll buy 2 boxes because it's a good deal. So why not apply the same logic to stocks? When stock prices fall, why not celebrate that you're getting a discount? Okay, so we judge how cheap or expensive a stock is by looking at its valuation. Basically, the stock valuation compares the stock price with the financial results of the company. And the most famous measure of valuations is the price-earnings ratio, also called the PE ratio. So you take the price of a stock, that's P, and you divide it by the stock's earnings per share, that's E. Basically, the PE ratio tells you how much do you need to pay to buy $1 of corporate profits. For example, if a company is making $5 per share and the share price is $50, then your PE ratio is 10. If the price is $150, then the PE ratio is 30. Okay, so now let's look at this chart from Barclays, which shows the average PE ratio in the American stock market over time. And we see that if 15 years ago, so let's say that's 2010, you could pay around $19 to buy $1 of earnings per share. Then earlier this year, you had to pay as much as $37.6 to buy $1 of corporate profits. So as you can see, over the past 15 years, American stock valuations have shot into the sky. Now, many people say this is justified because of profitable, fast-growing American tech companies. But at the end of the day, American stocks have become quite expensive. And over the past few years, many people have said, well, stocks are too expensive, I'm not going to invest. So these people might now say, all right, prices are falling, that's great. We're getting better valuations. We're getting a discount. It's a good time to buy. This does make some sense. If you buy stocks with lower valuations, then on average, statistically speaking, your expected future results are better. For example, according to one report from Vanguard, valuations could explain around 40% of expected stock market profits. In other words, when you buy stocks with lower valuations, that is not a sure indicator of better profits, but it is a good sign. Now, if you've been paying attention, you can probably see a major problem with assuming that Donald Trump's tariffs will definitely lead to lower stock valuations. But before I explain this problem, let me cover the third argument in favor of buying the dip. And it's this. If you have spare cash sitting around right now, so this is money that you don't need for other purposes, such as your current spending or your safety cushion, then buying the dip is statistically a better choice than leaving the cash in your bank account. If you invest, that comes with risk, obviously. It can happen that you invest and tomorrow the market drops even more. But if you don't invest, that is even more risky because your money is virtually guaranteed to lose value just sitting in the bank. So from this perspective, it's best to simply use the cash and buy the dip. Okay, so these are 3 strong reasons that people might have for buying the Trump tariff dip. Now let's look at potential problems with these reasons. First, does it really make sense to buy the dip because eventually stocks will go back up? Well, in the long term, sure, it does. But it's also true that in the long term, the sun will expand and swallow the earth. So the question is, what is your individual time horizon? The most recent dramatic market crash was in March 2020. That was the COVID crash. So if we look at that, we saw that stocks fell dramatically by as much as 34% in March 2020. And then within just a few months, the market completely recovered. So that was a really nice dip. If you bought when the market fell, you made a good deal of money. But this is not always the case. I started my career on Wall Street in August 2007, and that was right at the start of the financial crisis. Okay, so if we look at the chart of the market back then, the S&P 500 reached the peak in October 2007, and then it just kept falling and falling and falling until February 2009. And in fact, it took over 5 years before the market fully recovered. Now, looking at history books, 5 years can seem like a relatively short time. But trust me, when you are living through the pain, especially if your portfolio has big losses, it doesn't feel that way. And then, of course, the worst historical case is the Great Depression almost 100 years ago, where the market dropped big time and it took around 15 years to fully recover, even longer if you factor in inflation. Now, I don't think we have anywhere near that level of economic trouble today, but you have to keep this in mind. If you're buying the dip because you expect the market to always recover eventually, well, that's great. I generally think that makes sense, but you do need to be patient, and you also need to be ready to see losses in your account. When buying the dip, you never know if the dip is over or if the market will keep dipping and dipping and dipping into a major crash. So for example, if you tried buying the dip at the start of the financial crisis, you could have invested in February 2008 when the S&P 500 was down 15%. But if you invested $10,000 back then, over the following year, you would have lost another $4,500, 45%, until the market reached its bottom in February 2009. All right. So to come out a winner, you would have had to keep riding the wave. You would have had to stay in the market even as you saw massive losses in your portfolio, and that's not easy. Now look, I don't mean to scare you away from investing, not at all. Even in difficult times, investing is virtually always a better choice than not investing. Just make sure you have realistic expectations. Okay, and now we get to the second argument for investing now, which is lower valuations. So the price-earnings ratio is P over E, price divided by earnings per share. Now, obviously, if P, the price of a stock, decreases by 10 or 15%, then all else being equal, the PE ratio also decreases by 10 or 15%. Basically, you have an opportunity to buy the stock cheaper at a lower valuation. But there's a big assumption there. It's in the words, all else being equal. Basically, you're assuming that earnings per share, the letter E, will not change in this equation. It's like assuming that those €4 strawberries are just as good as €5 strawberries, when in fact, maybe the cheaper strawberries are starting to go bad. When you have a situation with America slamming massive tariffs indiscriminately on partners around the world, That's not exactly great for company profits. Here are just a few of the many articles where economists predict big trouble for economies around the world. So, looking at this, there's a big chance that company earnings could go down, and go down by a lot. And if that happens, we might find ourselves in a situation where stock prices go down, but stock valuations actually go up, because you're still paying a lot of money for a much smaller level of profits. In other words, just because there's a dip in stock prices does not mean that valuations are getting better. It does not mean that you are buying stocks cheaper relative to their financial fundamentals. Okay, and then there's the third argument, which is if you have spare cash sitting around, you should be investing. And actually, yeah, that's very valid. Basically, as a passive investor, you should be investing all money that is not necessary for your safety cushion and daily spending. But when you think about it, that's not really an argument for buying the dip. The real problem here is, why do you have spare cash in the first place? Unless you just got a big inheritance or sold your business or house. If you've been sitting on a lot of cash for a long time, that suggests that you have probably not been investing optimally until now. Now, of course, you might be feeling pretty good because this has allowed you to avoid this dip. But over the past 15, 17 years, keeping lots of cash on hand has been quite a suboptimal strategy. All right, so considering all these arguments, does it actually make sense to buy the dip? And should you take out a loan or sell your car to do so? Well, I don't have a crystal ball. I don't know where the market will go over the next few months or years. If anybody pretends they do, they're lying. That said, based on my personal experience, as well as all the market research I've studied, yes, it can make sense to buy the dip, but only if three conditions are met. One, you have the spare cash to invest, and you will not need this cash in the next few years. Two, you are able to wait long term. And three, you're willing to accept the risk of the market dropping further. If all of that is the case, then buying the dip can be smart. But taking a loan or selling your car or using your safety cushion to buy the dip is a very dangerous idea. Now, if you live in Europe and you're thinking about investing, you might have many questions like, what is a good investment right now? And which investments are just dangerous gambles? How much money can you expect to make? And how exactly do you buy a stock or ETF? If that sounds interesting, check out this video, my step-by-step guide to investing for beginners in Europe.